Hey, so in this video, I'm going to share with you 6 different ways to avoid paying capital gains tax on your profits or potentially reduce the amount you have to pay on your capital gains. And most of them are available for all Canadian residents, whether you are on temporary work permit or PR or even Canadian citizen, this may apply to you. So without any further ado, let's get started. Each of these strategies comes with its own caveats, so do try to watch without skipping as you might miss some of the important details otherwise. The first strategy is to use tax sheltered accounts to do your investments. According to last census, 65% of the Canadians contributed into their registered savings account or tax sheltered accounts. So if you are investing into TFSA or RRSP or even RESP accounts, you can technically avoid paying capital gains tax. So you can technically use these accounts to invest in the stock market, but you cannot use these accounts to pay for your real estate investments like rental property or vacation home. So instead, you can buy REITs, which is real estate investment trust. It's like ETF, but they invest into the real estates instead of investing to the stock market. Now let's look at primary residence exemptions. As per the data on this website, there will be approximately 1 million houses on the market to sell in the year 2023 and 2024. If you are selling your primary residence in Canada, you are technically exempted from paying capital gains tax on it. But only if you have physically lived at this place since you bought this place and haven't changed your primary residence right now. Also, it doesn't count if you are a flipper and flipping houses on regular basis. So this is a great argument for the people who are arguing between renting versus buying. Here you do not pay any taxes on the gains for your primary residence, but the rents you paid, you do not get any tax credits back on it. Now let's talk about donating to charity. You can completely avoid paying any taxes on your gains if you are donating it to charity. On top of that, if you are donating to charity, you get that donation tax credits which you can use to further reduce your taxes. Do you know there is also a way that you can defer the tax for lifetime? You know, if you are a small business and you are selling your business, you have a room up till somewhere around $900,000. It's the number there in 2023, but it's always adjusted to inflation. But the point here is that you don't have to pay any taxes on the sales value up till $900,000. But you can only do this once in your lifetime. Probably to know more about this, you should work with your accountant on how you can leverage this tax benefit. There are two other situations in which you can defer your taxes. The first one is death and the second one is divorce. In the death, in any situation, if some member of your family dies and you get the property as an inheritance, then you do not have to pay the taxes on those value until you sell those property. The capital gains taxes calculated in this case is from the beginning and not the time when you inherited these properties. Also, in the second situation where you have a divorce and your partner provides you with the properties instead of monetary value, then in that case, until you sell that property, you do not have to pay any taxes. And even when you sell, the property value does not start calculating the capital gains from the time you got the property, but it calculates the time from the moment they have purchased the property. But you have to make sure that this kind of tax deferral you can only use once in your lifetime, so you can use it technically as your trump card. Sorry, not that trump card, but I know you understood. Another way you can save your money on paying the capital tax gains is to spread your profits. Canada has a progressive tax system, and if you know, the more you make, the more tax you have to pay for that year. So if you can technically divide your profits into multiple years and convince your buyer to pay instead within 5 or 10 years, then you can technically reduce the taxes you need to pay for your capital gains, because you are not making all the money at once, but instead it's spread across the years. The risk here in this kind of situation is that your buyer may default after a few years, so you have to make sure you are working with them and you know them. There is a trust between you and the buyer. If you are selling stocks, then of course it's in your hand on when to sell your stocks, so you can technically, instead of selling everything at once, sell in chunks. And make sure that if you are dealing with a physical property or an asset, then you are having a good trust relationship with the buyer, or if not, potentially deal only with families when doing this. Now the next strategy is tax loss harvesting. For those who do not know about tax loss harvesting, this is a game changer. Let's understand how it works. For example, if you have invested $100 in the Apple stock and now the value of that Apple stock is worth $150, but at the same time you have invested $100 in your Amazon stock and the value of this Amazon stock has gone down to $50. So technically you can even off both these stocks. When you are selling, you are gaining $50, but you are also losing $50. So ultimately you end up paying no tax because you do not gain anything at the end of the day. And this does not necessarily mean that you have to sell these stocks at the same time. You can do it throughout the year, but at the end of the year, your total calculation should sum up to zero with the profit and loss. This is why it's called tax loss harvesting strategy, because you are utilizing your loss to actually benefit the profit. And some people will go to the next level when doing the tax loss harvesting, because they will see at the end of the year that some of their stocks are making some loss. They will sell those stocks and immediately buy similar assets, so they can add that capital loss into their overall calculation and get benefited for their capital gains at the end of the year when it comes to paying the taxes. And interestingly, imagine that you have paid some capital gains tax 3 years before and now you are incurring some loss. You can technically use the loss you have right now to get the tax back of the tax you already paid 3 years before. So it works in the 3-year window, but you just have to make sure that you are opting in to use this capital loss to get the tax refund for the tax you already paid 3 years before. So you can do this for last year or last to last year or even the year before. So last 3 years are counted for this strategy. And I am sure that if you learn how to do this tax loss harvesting in a good way, you can actually benefit of avoiding your capital gains altogether every single year. Unless you are making a huge profit every single year, then you have to pay some tax. So I hope this was helpful and you know what you have to do. Thank you very much and I will see you in the next one.